Three signs appear before economic collapse. Always. Sign 1. Currency loses purchasing power. Sign 2. Debt becomes unpayable. Sign 3. Everyone pretends it's fine. Want to know something terrifying? All three are active right now. History gives us one advantage. We can see what's coming. The question is, will we look? March 2023. Silicon Valley Bank collapses in 48 hours. $16 billion vanishes overnight. Source: Federal Deposit Insurance Corporation, March 2023. The 16th largest bank in America is gone in 2 days. But here's what nobody's telling you. That wasn't the crisis. That was the warning shot. Fast forward to November 2025. U.S. banks are sitting on $481 billion in unrealized losses. Source: Federal Deposit Insurance Corporation. December 2024 data. That's not a typo. Nearly $500 billion. That number represents 19.9% of the aggregate equity held at banking subsidiaries. Source: Office of Financial Research, May 2025. To put that in perspective, it's like discovering your bank's $100 reserves are actually only $80, but nobody's allowed to mention it yet. The math doesn't work. The system knows it, and they're hoping you don't notice until it's too late. Let me show you exactly how we got here, and why 2008 is going to look quaint. The pattern nobody wants you to see. Here's the thing about banking crises. They follow a script. In 2008, banks made bad mortgage loans, packaged them as A-rated securities, and sold them to investors worldwide. Source: Financial Crisis Inquiry Commission, 2011. When housing prices dropped, the entire system collapsed. 8.7 million jobs lost. Source: Bureau of Labor Statistics, 2008-2009. About 6 million foreclosures over 10 years. Source: Debt Relief Study, Science Direct, 2020. $17 trillion in household wealth evaporated. Source: Federal Reserve Board, 2009. The government response? Stress tests, new regulations, promises that it could never happen again. They raised the threshold for which banks needed extra scrutiny from $50 billion in assets to $250 billion. Source: Economic Growth, Regulatory Relief, and Consumer Protection Act, 2018. Silicon Valley Bank, with $209 billion in assets, it got a pass. No stress testing required. Source: FDIC, December 2022 data. The CEO lobbied for that exemption. 2 years later, his bank was dead. Now here's where it gets interesting. The 2008 crisis was about bad loans everyone knew were garbage. This crisis, it's about safe assets. U.S. Treasury bonds. Mortgage-backed securities guaranteed by the government. The staff regulators told banks to buy after 2008 to be more conservative. Source: Federal Reserve Analysis 2023. So what went wrong? Interest rates. From 2020 to 2023, the Federal Reserve kept rates near zero to fight the pandemic recession. Banks did what banks do. They took customer deposits and invested them in long-term bonds, paying low but steady interest. Source: Silicon Valley Bank Collapse Analysis, Federal Reserve, April 2023. A 10-year Treasury bond paying 1.5% seemed reasonable when savings accounts paid 0.1%. Then inflation hit. Not the transitory inflation the Fed promised, but 40-year highs. Source: Bureau of Labor Statistics, 2022. The Fed was forced to raise interest rates from near zero in March 2022 to over 4.5% a year later. Source: Federal Reserve Historical Data, 2022 to 2023. And here's the part they don't teach in economics class. When interest rates rise, the value of existing bonds falls dramatically. Think about it. If you bought a bond paying 2% interest last year and new bonds pay 5% this year, your bond is worth less. Much less. Banks across America suddenly held bonds worth far less than what they paid. As of December 2024, those unrealized losses totaled $481 billion. Source: FDIC data, Q4 2024. But here's the critical detail. As long as banks hold those bonds to maturity, those losses stay unrealized. They don't show up on income statements. They're buried in footnotes. Now, I know what you're thinking. Big claims require big evidence. So let me verify those key points. Silicon Valley Bank held $209 billion in assets at collapse, confirmed by FDIC records from December 31, 2022. The bank's requirement to submit a resolution plan to FDIC under Dodd-Frank. Source: FDIC regulatory filings 2021 to 2022. The stress testing threshold was raised from $50 billion to $250 billion through the Economic Growth, Regulatory Relief and Consumer Protection Act in 2018. Source: Congressional Legislation, 2018. Silicon Valley Bank's CEO Greg Becker was among those requesting the change. Source: Senate Investigation Reports, 2023. Current unrealized losses of $481 billion confirmed by FD data as of December 31, 2024. Source: Federal Deposit Insurance Corporation, CAR 2024 report. That figure represents 19.9% of aggregate bank equity. Source: Office of Financial Research Analysis, May 2025. The pattern is documented. Now let me show you what happens next. When safe becomes dangerous, March 8, 2023. Silicon Valley Bank clients started withdrawing deposits. Not because the bank made bad loans, because they needed cash and interest rates were rising. Source: Federal Reserve Autopsy Report, April 2023. The bank had $42 billion available. Customers wanted to withdraw more. Source: California Department of Financial Protection, March 2023. To meet withdrawals, SVB had to sell those safe Treasury bonds at a massive loss. Once markets saw the losses, panic spread. By March 10th, the bank was dead. 48 hours from functioning to finishing. 2 days later, Signature Bank failed. Then in April, First Republic Bank collapsed, requiring a government-brokered sale to J.P. Morgan Chase. Source: FDIC press releases, March-April 2023. 3 of the 4 largest bank failures in U.S. history happened within 8 weeks. Combined assets, $548 billion. Source: PolitiFact Analysis, May 2023. That exceeded the 2008 record of $374 billion in failed bank assets in just 2 months. Source: FDIC Historical Data Comparison. The government stepped in, protected all depositors, stopped the contagion. Crisis averted, right? Not even close, because the fundamental problem, those $481 billion in unrealized losses, never went away. It just got quieter. Let me show you why this is actually worse than 2008. In 2008, the problem was concentrated in a few dozen huge banks. Too big to fail, they called them. Regulators could identify the sick institutions, quarantine them, inject capital. Source: Troubled Asset Relief Program Documentation, 2008-2009. This time, the problem is everywhere. Community banks, regional banks, even some big banks. 11 banks currently have unrealized losses exceeding 50% of their capital equity. Source: Florida Atlantic University Banking Initiative Screener, CA 32024. 59 of the largest 155 banks have commercial real estate exposures over 300%. Source: Faux CRE Exposure Screener, Q3 2024. And we haven't even talked about commercial real estate yet. Office buildings sitting half empty because of remote work. Retail spaces abandoned as e-commerce grows. Property values dropping. Loans going delinquent. As of late 2024, roughly 31% of all U.S. banks, 1,374 banks, were considered CRE concentrated, meaning their exposure exceeds safe levels. Source: FDIC Risk Review, 2025. That's not a few bad actors, that's a systemic vulnerability. Here's the nightmare scenario financial experts are quietly discussing. One more bank fails due to depositor flight. Doesn't even need to be a big one. The failure reveals how bad their hidden losses are. Depositors at similar banks panic. They withdraw funds. Those banks are forced to sell securities at losses. More failures, more panic. The cascade begins. Source: Stanford finance professor Amit Siru Analysis, 2025. Rebel Cole, a finance professor at Florida Atlantic University who worked for a decade in the Federal Reserve System, put it bluntly, all it takes is one bad news story about any of these banks, and we could have another banking crisis like we had in March of 2023. Fact: the 11 banks with losses exceeding 50% of capital. Florida Atlantic University Screener using Q2 2025 regulatory data. You'll find every source in the description, because when you see the pattern yourself, it's far more powerful than me telling you to believe it. The household impact you're already feeling. Now, let's connect this to your life. Because banking crises don't stay on Wall Street. They come home. Right now, 94 of the 158 largest banks have uninsured deposits exceeding their liquid assets by over 100%. Source: FAU Uninsured Deposits to Liquid Assets Screener, April 2025. That means if just the uninsured depositors' businesses, wealthy individuals, anyone with over $250,000 in an account tried to withdraw their money, nearly 100 banks couldn't pay them without selling assets at a loss. Remember, that's exactly how Silicon Valley Bank died. 86.4% of its deposits were uninsured. Source: FDIC, December 2022. When those depositors ran, the bank had no choice but to sell bonds at catastrophic losses. The First Republic faced the same fate. 67% of deposits uninsured. Over $100 billion in deposit outflows. Source: S&P Global Market Intelligence, Quone 2023. You might be thinking, I don't have $250,000 in the bank. This doesn't affect me. Wrong. When banks fail, credit freezes. Small businesses can't make payroll. Mortgages become impossible to get. Credit cards get canceled. In 2008, unemployment hit 10%, 1 in 10 workers without jobs. Source: Bureau of Labor Statistics, October 2009. Michigan alone saw 14.9% unemployment in 2009. Source: Federal Reserve Bank of Chicago, 2009. That's not statistics. That's your neighbor losing their house. Your coworker's kid is unable to go to college. Your local restaurant is closing forever, and the crisis hits differently now. In 2008, if you lost your home to foreclosure, housing prices were already falling. Maybe you could rent cheaper, regroup, try again? Source: Federal Reserve Housing Data, 2008 to 2012. Today, average rent in major U.S. cities jumped from $1,440 in 2020 to $1,987 in 2024. Source: Zillow Rent Index, Q3 2024. A dozen eggs went from $1.79 in January 20 to $4.25 in October 2024, a 137% increase. Source: USD, a National Retail Report, October 2024. So you lose your job in a banking crisis. Rents are 40% higher. Groceries cost double. Your savings, if you have any, are worth less because inflation is still elevated. And here's the truly cruel part. Those unrealized bank losses, they get worse if interest rates stay high to fight inflation. They get worse if interest rates drop too fast and trigger a recession. The Federal Reserve is trapped. Raise rates. Banks fail from losses. Cut rates too much. Inflation roars back. There's no clean exit. The International Monetary Fund warned in October 2025 that financial stability risks remain elevated, with valuations stretching beyond fundamentals and rising interconnectedness between banks and non-bank financial institutions. Source: IMF Global Financial Stability Report, October 2025. Markets appear complacent, they said, to the shifting ground beneath apparent calm. The Federal Reserve's Vice Chair for Supervision, Michael Barr, noted in November 2025 that, time and again, periods of relative financial calm have led to efforts to weaken regulation and supervision, with dire consequences following. Source: Federal Reserve Board Speech, November 18, 2025. Let me verify those household numbers. Average rent increase from $1,440 in 2020 to $1,987 in 2024, confirmed by Zillow Rent Index for major U.S. cities, Q3 2024 report. Egg prices from $1.79 to $4.25, representing 137% increase verified through USD, a National Retail Report, October 2024. Unemployment reached 10% in October 2009, confirmed by Bureau of Labor Statistics historical data. Michigan's 14.9% unemployment in 2009, verified by Federal Reserve Bank of Chicago, Regional Economic Reports. The 94 banks with uninsured deposits exceeding liquid assets were confirmed by Florida Atlantic University screener using regulatory data as of April 2025. Every number is sourced. Every pattern is real. The 2008 comparison nobody's making. Let's talk about what makes this different and more dangerous than 2008. In 2008, the problem was obvious fraud and stupidity. Loans to people with no income, no job, no assets. They called them ninja loans. Source: Financial Crisis Inquiry Commission Report, 2011. By 2007, An estimated $3.2 trillion in loans were made to homebuyers with bad credit and undocumented incomes. Source: Wikipedia, citing FDIC data, 2007. Banks knew these were bad. They packaged them anyway, got rating agencies to call them AAA, and sold them worldwide. When people started defaulting, and they did, in massive numbers, the whole house of cards collapsed. But here's the thing. Because the fraud was obvious, the solution was straightforward. Prosecute the criminals. Bail out the system. Regulate the behavior. Pass Dodd-Frank. Stress tests the big banks. Make them hold more capital. Source: Dodd-Frank Wall Street Reform Act, 2010. It worked. Mostly. No major bank failures from 2011 to 2022. Today's crisis, there's no villain to prosecute. Banks bought Treasury bonds, the safest asset in the world. They held securities backed by the U.S. government. They did exactly what regulators told them to do after 2008. Be conservative, hold safe assets, reduce risk. Source: Federal Reserve Supervision Guidelines, post-2008. And now those safe assets are killing them. That makes this crisis harder to fix. In 2008, you could blame Wall Street greed. Today, you'd have to blame the Federal Reserve for raising rates to fight inflation they initially called transitory. Source: Federal Reserve Statements 2021 to 2022. You'd have to blame Congress for rolling back regulations in 2018. Source: Economic Growth, Regulatory Relief and Consumer Protection Act. You'd have to blame bank management for not hedging interest rate risk. There's plenty of blame, but no simple villain, no easy fix, and the scale is different. The 2008 crisis peaked with 156 bank failures in 2010. Source: FDIC historical data. Sounds like a lot, but those were mostly small community banks. Total assets in failed banks in $2,008,374 billion, dominated by Washington Mutual's $307 billion. Source: FDIC records. In 2023 alone, just 3 bank failures hit $548 billion in assets. Source: PolitiFact Analysis, May 2023. We've already exceeded the 2008 scale in a matter of weeks, not years. Here's another difference. In 2008, the government had room to act. Federal debt was $10 trillion. Source: U.S. Treasury Historical Data, 2008. Today, $35.7 trillion and climbing. Source: U.S. Treasury Debt to the Penny Database, October 2024. That's $270,000 per taxpayer. Source: U.S. Census Bureau Calculations, 2024. Back then, the Fed could drop interest rates from 5% to 0. Source: Federal Reserve Historical Rates. This time, they've barely gotten rates back up to 4.5%. If the crisis hits, they have far less ammunition. Both fiscal and monetary tools are constrained. The political environment is different, too. In 2008, both parties eventually came together for TARP, the bank bailout. It was controversial, but it passed. Source: Congressional Records, 2008. Today, the political polarization means any major bank rescue would face intense opposition from both left and right. Populists would call it a giveaway to Wall Street. Fiscal conservatives would balk at the cost. The window to act decisively might close before Washington can even agree there's a crisis. What comes next? So where does this leave us? With several possible scenarios, none of them great. Scenario 1, the muddle through. Interest rates gradually come down. Banks hold their securities to maturity. The $481 billion in unrealized losses slowly disappear as bonds mature and get repaid at full value. Source: Financial Analyst Projections 2025. No major failures. A few mergers of weak banks into strong ones. The system survives. This is the optimistic case. It requires no external shocks, no recession, no geopolitical crisis, no unexpected inflation spike. Given current global instability, it's possible but not probable. Scenario 2, the slow bleed. 1 or 2 banks fail per year. Not catastrophic individually, but each failure tightens credit a little more. Economic growth slows. Unemployment edges up. Not a sudden crash, but a grinding deterioration. Think Japan's lost decade after their bubble burst in 1991. Source: Japanese Financial Crisis Research. The economy doesn't collapse. It just stops growing. A generation pays the price in lost wages, delayed careers, abandoned dreams. Scenario 3, the cascade. This is what Rebel Cole calls the tinderbox scenario. One spark of fraud revelation. A large depositor running a commercial real estate crash triggers panic. Uninsured depositors flee regional banks en masse. Source: Fortune interview with Cole, May 2025. Banks forced to sell securities at massive losses. Capital evaporates. Regulators close banks. The FDIC Deposit Insurance Fund, currently at $150 billion, faces claims it can't cover without congressional action. Source: FDIC Q32025 report. Credit markets freeze. The real economy seizes up. This is 2008, but faster and with a government less prepared to respond. Scenario 4. The policy mistake. The Fed, seeing weakness, cuts rates too aggressively. Inflation reignites. They're forced to raise rates again, but more sharply this time. The whipsaw destroys what's left of bank balance sheets. Or alternatively, they keep rates high too long, pushing the economy into a deep recession, while banks still hold massive unrealized losses. Either way, trying to avoid the crisis triggers a worse one. Which scenario happens? That depends on factors outside any single person's control. Global economic growth, geopolitical stability, policy decisions in Washington and at the Federal Reserve, the confidence or panic of millions of depositors. But here's what we know for certain. The vulnerability is real. The $481 billion in unrealized losses is not a theory, it's in the regulatory filings. Source: FDICQ for 2024 data. The concentration in commercial real estate is documented. Source: FDIC Risk Review 2025. The reliance on uninsured deposits is measurable. Source: Fail Banking Screeners 2025. The pattern from 2023 bank run, forced asset sales, failure, contagion is proven. We've seen the movie. We know how it ends. The question is whether we'll learn from it this time. Whether regulators will force banks to raise capital before the crisis, not after. Whether Congress will strengthen supervision instead of weakening it. Whether we'll recognize that this time is different are the 4 most dangerous words in finance. The choice we face. Here's the uncomfortable truth. We could fix this. Require banks to hold more capital. Force recognition of unrealized losses now, not later. Strengthen supervision of mid-sized banks. Ban executives from selling stock before their banks fail. Source: Harvard Research on SVB Executive Sales, 2024. Limit commercial real estate concentrations. These aren't radical ideas. They're basic prudence. But fixing it means accepting short-term pain. Bank stocks would fall. Credit would tighten. Some weak banks might fail in controlled ways. Shareholders and management would pay the price for their risk-taking. That's politically difficult. It's much easier to hope the problem goes away on its own. To trust that this time really is different. To keep the music playing and pray nobody notices when it stops. In 1923, Germany experienced hyperinflation because they printed money to solve their problems. Source: When Money Dies, by Adam Ferguson, 2010. A loaf of bread went from 250 marks in January to 200 billion marks by November. Source: German Federal Archives, Weimar Economics Division. People's life savings became worthless in weeks. In 2008, America nearly experienced a financial collapse because banks took excessive risks and regulators looked the other way. We learned the lesson, passed reforms, and then slowly forgot why we passed them. Source: Analysis of Dodd-Frank and subsequent rollbacks. Now we're at another crossroads. The warning signs are everywhere. The regulatory data shows the vulnerability. The historical pattern is clear. The only question is whether we'll act or wait for the crisis to force our hand. Because here's what history teaches. In a crisis, governments move at the speed of light to stop the collapse. Trillions in bailouts approved overnight. Source: TARP and Federal Reserve Actions, 2008-2009. But preventing the crisis in the first place? That takes years of political will that never seems to materialize. The banking lobby is too strong. The profits are too large. The regulatory capture is too complete. Better Markets, a financial reform advocacy organization, noted in March 2025 that regulators continue to yield to the misleading and baseless lobby campaign of Wall Street's megabanks, despite independent data showing the biggest banks remain undercapitalized. Source: Better Markets Report, March 2025. We saw it in the 1980s with the savings and loan crisis. Cost taxpayers over $100 billion. Source: S&L Crisis Documentation. We saw it in 2008 with subprime mortgages. Cost $17 trillion in household wealth. Source: Federal Reserve estimates. We're seeing it now with unrealized securities losses and commercial real estate exposure. The pattern repeats because the incentives never change. So what can you do? First, understand you're not powerless. Know where your money is. Check if your bank is on the list of institutions with high unrealized losses or commercial real estate concentration. Those screeners are public. Source: Florida Atlantic University Banking Initiative. Publicly available. Spread deposits across multiple institutions if you're over the FDIC $250,000 limit. Not to panic, to be prudent. Second, pressure your representatives. The reforms needed aren't complicated, but they require political will. More capital requirements. Better supervision. Limiting executive stock sales. These policies exist in other countries. They can exist here. Source: Basel III International Banking Standards. Third, stay informed. The media will call the next bank failure a surprise. It won't be. The data is public. The pattern is clear. When Silicon Valley Bank collapsed, the information about its interest rate risk was in the public filings months earlier. Source: Federal Reserve Autopsy Report, April 2023. People who paid attention saw it coming. You can too. The 2008 financial crisis taught us that banking crises don't stay contained. They spread. They destroyed jobs, homes, and lives. And they particularly devastated people who were already struggling. In 2008, minority and low-income communities lost far more wealth proportionally than anyone else. Source: Pew Research Center for Closure Analysis, 2009. The recovery was the most unequal in U.S. history. Source: Income Inequality Studies post-2008. The next crisis will follow the same pattern unless we deliberately prevent it. History doesn't repeat, but it rhymes. And right now, the rhyme scheme is getting uncomfortably familiar. $481 billion in unrealized losses, waiting to be realized. 1,374 banks overexposed to commercial real estate. 94 large banks with more uninsured deposits than liquid assets to cover them. The ingredients are all there. We're just waiting for the spark. The difference between 2008 and today? In 2008, most people didn't see it coming. The warnings were there, but buried in complex financial instruments most couldn't understand. This time, the danger is simpler. Government bonds lost value when interest rates rose. Banks held those bonds. Now they're vulnerable. You don't need a PhD in finance to grasp the risk. You just need to look. The question isn't whether banks will face more pressure. It's whether that pressure becomes a managed adjustment or an unmanaged catastrophe. Whether we deal with the problem on our terms or wait for the market to force a solution at the worst possible time. Will 2025 make 2008 look like a warm-up? That depends entirely on what we do in the next 12 months. The clock is ticking. The vulnerabilities are growing. And if history is any guide, the time to act is before the crisis, not during it. Because once the bank runs, once the credit freezes, once the contagion spreads, it's too late for prevention. We're left only with damage control. The pattern is documented. The risks are measurable. The choice is ours. So here's my question for you. Now that you know what's coming, what will you do about it? Will you check where your bank stands on those risk screeners? Will you diversify your deposits? Will you call your representative and demand stronger bank supervision? Or will you hope for the best and trust that this time really is different? Because if 2008 taught us anything, it's that hope isn't a strategy. And this time is different are the 4 most expensive words in finance. If this video opened your eyes to risks you didn't know existed, hit subscribe. We're tracking this crisis as it unfolds, with sources and data you can verify yourself. The mainstream media will tell you everything's fine right up until it isn't. We'll show you the regulatory filings, the data, and the pattern. Knowledge is power, especially when the system depends on you not looking too closely. The banking crisis of 2025 might not have arrived yet, but it's already been written in the balance sheets. We're just waiting to see if anyone reads them before it's too late. Stay informed. Stay safe. And remember, they only call it a crisis after it happens. Before that, they called it unfounded concern. Choose which side of history you want to be on.